Hi everybody, I'm Gordy Marks with RE/MAX Northwest Realtors, and I'm here today with Kerry Day at Cornerstone Home Loans. And we just want to thank you for spending a little bit of time with us. Today we're going to talk about the impacts of credit score and how that impacts your cost of ownership and barrier of entry into obtaining a mortgage on your home. So I'd just like to start out, Kerry, with asking you a question. You know, credit score is something that is kind of mysterious.
Right.
Even for people in the industry, we don't always know what goes into a credit score. Our credit scores move up and down, it seems like almost daily. And what is making that happen, and how does it impact the cost of home ownership? Can you share a little bit of that?
Yeah, so great question. I would say first off that there's a reason that your credit score seems a little bit mysterious, and it's because the credit bureaus don't want you to be able to fully manipulate your score, right? They don't want you, when you're ready to buy a mortgage, to just be able to artificially prop it up, right? So we know some of what plays into a credit score, but not all of the minutia, not every lever to pull. And so some of the big buckets are things that make sense, right? So number one is your payment history, right? Do you have a history of paying your debts on time? And if so, that's going to go a long way in giving you a good credit score.
And one thing I noticed in my own credit history, at one point we were offered a larger credit limit on one of our credit cards or credit lines, and thinking that might be a good thing for bolstering our credit, I think we accepted, or maybe we didn't even give much thought to it. But I didn't think it would have any really impact in that, as long as we weren't using that credit. But it turns out that the ability to borrow a larger amount sometimes is a negative, because you could instantly make a large purchase.
Yeah, it can go both ways. So one of the things that plays into your score is, have you recently incurred new debt, right? So usually, again, it's good to have a variety of debt options. But at the same time, if you've just opened a car loan or just opened a credit card or just opened a mortgage, usually that's going to take a little bit of an immediate hit, right? So it's going to have a short-term, at least, impact on your score. So on the other side of what you're describing, sometimes, maybe let's say you have a $5,000 mortgage balance and a $6,000 credit line. Well, if you can push that $6,000 credit line to $15,000, well, then almost, rather than being almost maxed out on that credit card, now you're like at 30% utilization. So the credit bureaus like to see that you're not utilizing much more than 25 to 35% of your revolving credit. So that's where having a higher credit limit can help you, because again, they don't want to see that you're coming up, you're leveraged. That's what they're looking for. So,
and Kerry, when we're counseling our clients, trying to get them the best interest rate possible, which does have a relativity to the credit score, we're trying to help them decide which accounts to maybe pay down or pay off versus which ones to not pay down or pay off. Can you give an example of a type of credit situation where it made sense for a client to pay off a certain account and not another one?
Yeah, so there's two things that I think of in terms of paying off debt, or I should say choosing which debt to pay off, right? Because when you are purchasing a home, getting a mortgage, you're usually bringing some cash to the table for your down payment or for closing costs, and sometimes you have enough that you could choose to put more towards your mortgage or towards the home purchase, or you could choose to keep some on the sidelines to apply toward that existing debt, right? I think that's kind of what you're asking.
Exactly.
And so the question, there's two things that I think of. One is, how much is that other debt costing you in terms of financing charges, right? Really in terms of rate that you're paying, in terms of interest that you're paying for that borrowing. And then number two is, how much is it leveraging your monthly cash flow? Okay, so the first is just interest. How much are you paying? If you're paying 7% in interest on a student loan, and you could be paying, let's say, 4% in interest on a mortgage, well, obviously, you're going to save interest if instead of throwing 10 grand more at your house purchase, you throw that 10 grand at that higher interest student loan, right? That's going to save you interest. That being said, maybe that student loan has a income-based payment or something like that. So maybe even though it's higher interest, maybe you're paying $50 a month for that 10 grand student loan, and you're going to be paying potentially more by not throwing that money at the mortgage. So it just depends on your unique situation. So what we'll do is we'll counsel with a client and say, what's most significant to you? Is it having the lowest payment possible? Is it paying your debt off as possible? Is it being debt free? And then with that, we'll strategize before they go and throw their cash in a place that they can't get it back. So that's one of the really critical things is don't go start paying stuff off if you have any uncertainty about whether it's good or not for your mortgage qualifying situation, because as soon as you throw $10K as a student loan, guess what? You're not getting that $10K back.
And Kerry, that's one of the things I really appreciate about you is that you look at every situation uniquely, and that there's not one size that fits every scenario. Mm-hmm. So you look at every borrower and really dissect their needs and their abilities and help them, give them the best advice for their scenario.
Yeah. Can I give you one more example of what that might look like? So a lot of times we'll have a client that comes in and they've got a car loan, and car loan rates are pretty good right now in general. So oftentimes they're competitive with mortgages, or even sometimes they have a better rate than on a mortgage. But oftentimes they have a shorter amortization period. Mm-hmm. So meaning they have a more aggressive payoff. They have a more significant amount that has to go towards principal on a monthly basis. So if a client comes in and they've got a $25,000 car loan, well, that car loan is, let's say that it's costing them $500 a month. Okay, that $500 a month, or that $25,000 car loan, compared to $25,000 in a mortgage. In the mortgage, it would probably cost them $125 a month, versus $500 potentially for that car loan, right? And so obviously we're making up numbers right now, but the point is a mortgage is amortized over 30 years, and so the month-to-month expense in terms of cash flow, money leaving your bank account, is much less in most cases on a mortgage than on a car loan. So that's something where if a client's trying to qualify for X amount, we can say, well, take this cash that you otherwise would have put towards your mortgage, pay it towards your car loan, and bam, you've just increased your borrowing power, in this case, by, close to $100,000 in that theoretical scenario.
And Kerry, aren't there situations where by paying off that car loan, wiping out that debt completely will actually open up a whole new set of mortgage options for that borrower?
Sure.
So, really managing the debt load is really critical to actually the cost of the property that you end up buying.
Right. Yeah, it can make a huge difference. People are, and that's one of the things that we see right now when we're in a really great low interest rate environment, is people are shocked how little extra mortgage debt costs.
Yeah.
Okay. And so when you say, well, hey, you could bump your price range up by $100,000 if you can afford another, $500 a month.
Yeah.
$500 a month isn't nothing, but that's pretty affordable.
Yeah.
All things considered, when we're talking about $100,000. Right.
And this whole subject is so critical, things that we talk about in our initial consultation with every buyer that we meet with, because it really determines the route that we take and the timeline that we take. So sometimes finding out your credit score and your exact debt load up front will really dictate when we should be looking at houses.
Absolutely.
Many times we've gone in and pulled credit in getting prepared for the purchase, and found that if our client's credit score was just maybe 10 points higher, they would qualify for a rate that was drastically less, costing them thousands of dollars less. And so what we can do with the help of Kerry and his team is we can go in and restructure their debt, maybe pay a few things off, as we mentioned, and over time they can do what's called a rapid credit rescore, and we can come back. Sometimes it's just even a few months.
Right.
You can come back and now qualify for a much lower rate of interest, which could impact your overall interest by tens of thousands of dollars in the long run.
Thanks so much for tuning in today. Be sure to be on the lookout for our future videos. And as always, like, comment, subscribe below. Thanks so much.